Hello, good evening. Good evening, everyone. In the previous class, we have completed the first question of the November 20 attempt SFM paper. So 1A, 1B, 1C is completed. This is 2A. This also a simple problem, but bit analytical. You should be bit careful. All are formula based problem only, but just analytical you should be there. Right. Look at this problem 2A. AB Industries has equity capital of rupees 10 lakhs, total debt of rupees 8 lakhs, and annual sales of rupees 30 lakhs. Two mutually exclusive proposals are under consideration for the next year. The details of the proposal are as under. Particulars: proposal number 1, proposal number 2, total assets to sales ratio, total net profit margin, target debt equity ratio, target retention ratio, annual dividend, new equity raised. You are required to calculate sustainable growth rate for the above proposals. We are required to calculate sustainable growth rate for the above proposals. What is the formula? What is the formula we have seen for sustainable growth rate? So sustainable growth rate. What is the sustainable growth rate? Okay. So sustainable growth rate, we have a formula. Sustainable growth rate. So I'll explain this formula. Sustainable growth rate. Okay. So sustainable growth rate is equal to B into R, that is retention ratio into return on equity, return on equity. So it's a very simple concept, Sustainable growth rate is equal to retention ratio into return on equity, Very simple common sense logic, nothing technical here. Return on equity. So how much our assets will grow? How much our assets will grow depends on how much our assets will grow, depends on how much we are saving out of our income. How much we are saving? How much we are saving out of our income? And how much we are earning on that savings? On that savings, as simple as that. So here we refers to company. So how much is company is earning? How much is company's income? Company's income is net profit. How much is saving? Saving is nothing but retained earnings. As simple as that. The total income earned by the company is under net profit. Total income earned by the company is net profit. Out of that, whatever is retained within the company is nothing but retained earnings. The balance is given away. How much company will grow, not how much shareholders will grow. Sustainable growth rate, the growth rate of the company. So company may be earning 100 crores. Out of that, the company has given away 80 crores to the shareholders. So what is retained is only 20 crores. On that 20 crores only I'll rotate it. So therefore, how much is retained? I might have earned 2 lakh salary, but out of that I have spent 1,20,000. So therefore 80,000 is only my retained earnings. My assets will grow only to that 80,000, and whatever the bank fixed deposit interest rate I'll get. So today my assets are zero. Take for example, today my assets are zero. How much I can increase? My assets? So out of 10 lakhs, if I spend 8 lakhs, 2 lakhs is savings. On the 2 lakh savings, banker is giving 10%. So therefore 2.2 lakhs is my asset. So that my assets depends upon how much I am saving. These are the two variables which determine my assets. How much I am saving, and on that saving how much I am earning. As simple as that. How much I am saving, on that saving how much I am earning. Okay. So how much of our assets will grow or how much we grow depends on how much we are saving out of our income and how much we are earning on that savings. So here we refers to company. So how much company is earning, company's income is profit, and whatever is savings within the company is nothing but after paying dividend. Whatever is the retained earnings, the savings is nothing but retained earnings. How much we are earning on that savings, this earning is nothing but return on equity. Whatever is the equity invested in that company, how much the company is earning on that, that is called as return on equity. So therefore, it's a very simple concept. Sustainable growth rate. How much will grow depends on how much we are saving on that savings. How much we are earning. As simple as that. Out of your salary, how much assets will grow depends upon what is your salary. Out of that, what is your expenditure? How much you are saving. In that saving, where you are, how much you are earning. If you invest somewhere in bank fixed deposit, you'll get less amount. If you invest in stock markets, you'll get more amount. So therefore, your bank balance year after year depends upon how much we are saving every year out of our salary. Your bank balance year to year depends upon how much we are saving from your salary and that savings where you are investing. In order to increase your balance, either you have to save more or you have to earn more on what you are saving. Either you have to save more or you have to earn more on what you are saving. As simple as that. In order to grow your bank balance sheet, either you have to save more out of your salary or whatever you have saved, you have to earn more out of that savings. Too simple logic. If you are doing both, it's well and good. Okay, it's a great. If you are able to do both, if you are able to save more and you are able to earn more on that your savings, your growth will be tremendous. Okay, that is what the point. So therefore, sustainable growth rate is equal to how much we are saving out of our income and how much we are earning on that savings. Okay, right. This is sustainable growth rate. Retention ratio into return on equity. This is a plain simple concept, my retention ratio and return on retention ratio. The first proposal they have given. First we'll look at proposal 1. Proposal 1 75 they have given retention ratio. Retention ratio 75% they have given, straight simple. No complicated. Okay. Right. The next thing is we have to calculate return on equity. What is the return on equity? As I told you multiple times, return refers to income expressed as a percentage of investment. What is my income? How I am expressing it as a percentage of investment. Okay. So return on equity is nothing but earnings available to equity shareholders divided by equity investment. As simple as that. Earnings available to equity shareholders divided by equity investment. Numerator is my total income and denominator is my investment and the output is return. Both are my profit only. This is expressed in rupees terms, absolute terms. And this is percentage terms. Percentage refers to relative terms. Relative to the investment. Why we have to show relative? Because we have to standardize to facilitate comparison. If one of my business gives 30 crores profit, another business gives 35 crores profit, I can't blindly go to the 35 crores profit. I should look out to the investment. If the investment here is 100 crores, if the investment here is 200 crores, it is giving 30% return. Here it is giving 17.5% return. So therefore, it's a blunder mistake to go for this report. So I can make the comparison only if I convert my profit into return. I can compare two investments only if I can convert my profits into return terms. So why it is necessary to convert profit into return? To facilitate comparison. Earnings available to equity shareholders is an absolute measure. It is measured in money terms. Return is a percentage terms. It is a relative measure. Earnings available to equity shareholders is an absolute measure. Return is a relative measure. It is standardized with the investment. Return you can compare with any size of the investments. Okay, right. That is the point. So this is the earnings available to equity shareholders divided by equity investment. Return on equity. How much I am getting on how much I have invested. If I invest 100 rupees, I am getting 2 rupees. Therefore, 2% is my return. If I am investing 200 rupees, I am getting 4 rupees. That means I am getting 20% return. Okay. So earnings available to equity shareholders divided by equity investment. That is what? Plain simple. A return on equity. So return on equity is equal to, so what is the first thing we need to write? The first thing we need to write is earnings available to equity shareholders. 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 Okay, ma? Earnings available to equity shareholders divided by equity investment. Divided by equity investment. So this is nothing but return on equity. Return on equity. Okay, right. This is what the point. Earnings available to equity shareholders divided by equity investment is equal to return on equity. Now, how will you get the earnings available to equity shareholders? Very simple. Net profit minus preference dividend. Just I'm going to the table. Net profit less preference dividend. Net profit less preference dividend. Net profit less preference dividend is equal to earnings available to equity shareholders. So how will I get that net profits? How will I get that net profits? Assets into net profit margin. So sales into net profit margin. Sales into net profit margin. In the given case, no information is given related to cost, expense, etc. So directly you can jump from sales to net profit. Directly we can jump from sales to net profit because the information is given related to the net profit margin. Since the information is given relating to both, directly you can correlate sales with the net profit. We don't need to come to your profit and loss account, trading account, etc. Directly you can start from sales and we can start from net profit. So here it is sales. Here, if you put our trading account, right? So normally here we are sales, Here we are sales and it is a net profit. Normally we want all this information. In the given problem, we no need to have all the information because directly the relationship they have given. Relationship with sales and net profit is nothing but net profit margin. Since they have given a highway directly to come from sales to net profit margin straight away, no crossroads. So therefore, these are all not necessary for us. Directly we can come from sales to the net profit using this relationship called as net profit margin. Using this relationship called as a net profit margin. This is sales. And next point is, what is the sales? How will you get the sales? Look at this question. In the question, what is the information they have given? Total assets to sales ratio they have given 0.65. Total assets to sales ratio is equal to 0.65. This is what the information they have given. So therefore, total assets to sales ratio. Look at this, any new ratio, whatever is the word left side to the 2 will come in the numerator. The words left side to the 2, total assets to sales ratio. Total assets to sales ratio. Total assets to sales ratio. So the word left side to the 2 is nothing but numerator. So this will be the numerator. This will be the numerator. And this will be the denominator. And this will be the denominator. If at all you come across any new ratio, look at the word called as 2. The word left side to the 2 is a numerator and the word right side to the 2 is a denominator. So therefore, my formula will be total assets divided by sales. Total assets divided by sales is equal to 0.65. 0.65. So therefore, how will I get sales? Total assets divided by 0.65 is equal to sales. As simple as that. I'll take the sales to here and I'll take 0.65 here. Total assets divided by 0.65. Total assets divided by 0.65. So sales is equal to, how will I write? Total assets divided by 0.65. Total assets divided by 0.65. So I'll get total assets. Total assets. I'll get total assets. Okay, ma? So I'll get total assets. How will I get the total assets? How will I get the total assets? Total is nothing but is 2 points. Equity and debt. Equity and debt. Equity and debt. Equity and debt is equal to total assets. Equity and debt is equal to total assets. That means here we are assuming that current assets is equal to current liabilities. As simple as that. If the current assets is equal to current liabilities, we'll end up total assets is equal to equity plus debt. We'll end up total assets is equal to equity plus debt. Look at this point. Look at this. Right. So look at this point. So if I take this, my balance sheet, liabilities, assets, my liabilities, assets, this is called as equity capital and this is called as debt capital. Together is a total capital and this will be my current liabilities. And here it will be my current assets. Here it will be my current assets. Here it will be my fixed assets. Here it will be fixed assets. Therefore, total assets, I don't know. Total assets, I don't know. I don't have fixed assets. I don't have current assets. If I assume that current assets is equal to current liabilities, this is what my equity plus debt is equal to total assets. Equity plus debt is equal to total assets. That is one way. Or you can assume that this debt is equal to total debt. Equity, total debt. This is long-term debt. And this is short-term debt. Equity, long-term debt plus short-term debt is equal to total liabilities. So therefore, total liabilities is equal to total assets. This is how you can understand. Equity, either you have to, normally the debt means long-term debt. The debt means a capital or long-term debt. You cannot combine short-term debt with the equity. Normally the short-term is a working capital excess. Debt means I have to take a long-term capital. But in the given case, current assets and current liabilities is not given. So therefore, I am assuming that what they have given is a total debt. Look at this question. What is the information they have given? What is the information given? Total debt. So therefore, I have to take both short-term debt and long-term debt. Otherwise, debt means it's a long-term debt only. But in the given case, they have given information related to both short-term debt and long-term debt. So therefore, this short-term debt is nothing but current liabilities. Normally, this is the case. Normally, 2 points. One is my sales I have to apply with the fixed assets. My sales depends on my production. My production depends on my machinery. That is nothing but fixed assets. My sales depends on my production. My production depends on my machinery. That machinery is nothing but fixed assets. Therefore, conceptually speaking, we have to relate sales to the fixed assets. Just because we are keeping more inventory in my godown, I cannot get my customer. I cannot sell it. So therefore, I need to produce with the help of machinery. Based on the production only, I can get sales. So therefore, normally speaking, conceptually, it is appropriate to link fixed assets with the sales. But in the given case, they are giving total assets. Accordingly, they have given total debt. So conceptually, total long-term debt we have to take, and we have to take fixed assets. In the given problem, they have given different information. Therefore, we are taking total assets and total debt. So normally we have to take fixed assets and long-term debt. That is the conceptual speaking. But in the given case, we are ignoring this and we are going based on the information given in the question. Total assets and total debt. Okay. Right. So total debt, equity plus long-term debt plus short-term debt is equal to liability side. Short-term debt is nothing but current liability. So we have the total liability side. Obviously, I'll get total assets. Okay. So therefore, total assets is equal to, what should I write? Total assets is equal to equity plus total debt. 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 What is the present equity? What is the present equity? Look at this in proposal 1. In proposal 1, we are not borrowing any equity. In proposal 2, we are borrowing we are taking 1 lakh, we are raising 1 lakh equity share capital, new capital. But in proposal 1, we are not raising any capital. In proposal 1, we are not raising any capital. So therefore, our assets will remain intact. So therefore, our total debt equity will be 12 lakhs and debt will be 8 lakhs as it is. Equity will be 12 lakhs and debt will be 8 lakhs. So therefore, total assets will be equity plus debt. Total assets is equal to total liabilities is equal to equity plus debt. Total assets is equal to total liabilities is equal to total liabilities is equal to equity plus debt. As simple as that. Okay, this is the point. Equity plus debt. So this will be 20. This will be 20. How I got the 20? Equity plus total assets liability. And then what is the sales? I told you total assets divided by 0.65. Total assets divided by 0.65 will get 30.77 of the sales. What is the net profit margin they have given? Net profit margin they have given is 4%. Net profit margin they have given is 4%. So therefore, net profit will be this point. Net profit will be this point, 1.23. And what is the preference dividend? No information is given. Therefore, 0. Therefore, 0. Net profit minus preference dividend. This is 1.23. And what is my equity investment? Same. Equity investment is 12 lakhs. Equity investment is 12 lakhs. So therefore, equity investment will be 12 lakhs. Therefore, my return on equity, I'll write it in lakhs. So therefore, my return on equity, will be this point. My return on equity will be 1.23 divided by 12. So I'll get 10.26. How I got return on equity? Return on equity, earnings available to equity shareholders divided by equity investment. Equity shareholders funds. Equity shareholders funds. Equity shareholders funds. I should not use equity share capital because equity shareholders funds includes retained earnings. Equity shareholders funds. Equity shareholders funds. So based on that, we have to calculate not only equity share capital along with the retained earnings. Okay. So equity shareholders funds is equal to 12. So therefore, return on equity is equal to 10.26%. And what is the retention ratio? This is earnings available to equity shareholders. Earnings available to equity shareholders. Earnings available to equity shareholders. And what is the retention ratio they have given? Retention ratio they have given. How much they have given? 0.75 retention ratio they have given. Therefore, sustainable growth rate is equal to return on equity is equal to retention ratio. How much I am saving? Retention ratio into return on equity. Retention ratio into return on equity. How much I am saving? On that saving, how much I am earning? So this will be 7.69% will be the sustainable growth rate. Sustainable growth rate under proposal 1. Sustainable growth rate under proposal 1. Sustainable growth rate under proposal 1. Okay, ma? Sustainable growth rate under proposal 1. So this will be the proposal 1. So this will be proposal 1. Proposal 1. Okay, proposal 1. What is the nomenclature they have used? 1 or 2? Proposal 1. Okay, proposal 1. I'll take 1. Proposal 1. Okay, proposal 1. This is the proposal 1. So I have given every information, everything I have given clearly. How we got a particular figure. Look at this equity. They have given the information. So equity, they have given the information, and total assets is equal to total liabilities is equal to equity plus total debt. Sales is equal to total assets divided by 0.65. That also we got. And net profit margin they have given. Net profit is equal to what? Sales into net profit margin. Sales into net profit margin. Sales into net profit margin. Preferences, earnings available to equity shares. How we got? Net profit minus preference dividend. 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 Earnings available to equity shareholders is equal to net profit minus preference dividend. That is 1.23 as it is will get. This is 7.69. Okay, ma. So this is the sustainable growth rate under proposal 1. Now we'll go to proposal 2. Now we'll go to proposal 2. We'll go to proposal 2. Okay, right. So proposal 2 will be bit different. No, proposal 2 will be bit different. We have to calculate. So proposal 2. Proposal number 2. So proposal 2. So proposal 2, equity will be 13 lakhs. Why 13 lakhs? Because 12 existing 12 plus 1 lakhs. Existing 12 lakhs. Existing 12 lakhs plus 1 lakhs new equity raised. Existing 12 lakhs plus 1 lakh new equity raised. Existing 12 lakhs plus 1 lakh new equity raised. Existing rupees 12 lakhs. Existing rupees 12 lakhs plus 1 lakh new equity raised. Plus 1 lakh new equity raised. Plus 1 lakh new equity raised. Look at the proposal number 2. 1 lakh new equity raised. 1 lakh new equity raised. This is what the point, 13 lakhs. Here the point is that debt will change. Debt will change. Why the debt will change? Look at this. So in the given case, they have given, if you look at the proposal number 1, we have ignored one ratio in the question. What is that ratio we have ignored? We have ignored this ratio of total debt equity ratio is 2:3. Because that is not necessary. That is already there in the question. Look at this, debt equity ratio is equal to 2:3. What is meant by debt equity ratio is equal to 2:3? So debt equity ratio is equal to 2:3. As I told you, first we'll take the left side figure. Debt equity ratio. Debt divided by equity is equal to 2/3. Debt divided by equity is equal to 2/3. That is what we want. Look at this, whether it is matching or not. Yes. What is the equity? What is the equity? Equity is how much? Equity is how much? 12 lakhs. Equity is how much? And debt is how much? 8. If you take by 4, 4 2 ja 8, 4 3 ja 12. 4 2 ja 8, 4 3 ja 12. We will get 8/12. 8/12. That means that ratio is already there. We don't need to do anything for that. That ratio is already there. Therefore, I am not touching that point. For proposal 1, the debt equity ratio is matching. Therefore, the debt equity ratio and my total assets both are matching. I am not disturbing my debt equity ratio. I am not disturbing my debt equity ratio. Therefore, proposal 1, that is proposal 1. But if you look at the proposal 2, they are saying debt equity is equal to. What is the debt equity ratio they have given for proposal 2? For proposal 2, the debt equity ratio is 4:1. The debt equity ratio is 4:1. So debt equity ratio is equal to 4:1, and equity we have 13, and debt will be 4 times of that. Debt will be 4 times of that. 13 4 is 52. This should be 52. 52. How I got 4 times of 13? 4 times of 13. So therefore, this is a 52.5. Therefore, what is the total assets? Total assets is equal to total debt plus equity. That is equal to 52 plus 13 is equal to 65. That is the total assets. 52 plus 13 is equal to 65. So therefore, how will I get debt? So debt. So how will I get the debt amount? Total debt. I'll write better. I'll write it total debt. I'll write total debt. Okay, total debt. Equity, total debt. So how will write the total debt? So debt equity ratio is equal to 4:1. Debt equity ratio is equal to 4:1. So debt equity ratio is equal to 4:1. 4:1. That means let's say 4/1. Debt equity ratio is equal to 4/1. So therefore 4/1 is equal. So therefore debt is equal to equity into debt equity ratio. Debt divided by equity. So look at this point. Debt equity ratio is equal to 4:1. Debt equity ratio is equal to 4:1. So debt equity ratio is equal to 4:1. How I have to convert it to fraction? Right. Debt divided by equity is equal to 4 divided by 1. So that E bring down and 1 bring down. Debt is equal to equity. So therefore, debt is equal to equity into 4 divided by 1. So equity into 4 divided by, so debt is equal to equity into debt equity ratio. Debt is equal to equity into debt equity. So that 4 is nothing but debt equity ratio. That 4 is nothing but debt equity ratio. So debt is equal to equity into debt equity ratio. So total debt is equal to what? Equity into debt equity ratio. Equity into what is the debt equity ratio? Total target debt equity ratio into debt equity ratio. Into debt equity ratio. that is equal to 13 lakhs into, that is equal to 13 lakhs into 4, that is equal to 13 lakhs into 4, 62 lakhs is equal to 13 lakhs into 4, 62, 52 lakhs. I'll get 65 lakhs is the total. And here sales by total assets, they have changed the information. What is the information they have given? Sales by total assets 0.62. Just take it as 0.62. Take it as 0.62. Okay. So it will be 0.62. We'll get 104.84. And net profit margin is changed 5%. Proposal number 2, net profit margin is 5%. Preference dividend 0. Equity shareholders funds EK. Here return on equity, you have retention ratio, we need to calculate separately. Retention ratio. How will you got the retention ratio? Retention ratio, here nothing is given. So therefore we have to take it out, 1 minus payout ratio. Retention ratio is equal to 1 minus payout ratio. 1 minus payout ratio. What is payout ratio? What is payout ratio? Is equal to 1 minus payout ratio is equal to what? Dividend divided by earnings. Dividend divided by earnings is equal to payout ratio. Dividend divided by earnings is equal to payout ratio. That is equal to 1 minus dividend divided by payout ratio. Dividend is how much? 0.3. Divided by earnings is how much? Earnings available to equity shareholders 5.24. So therefore 0.94. 0.94 is the retention ratio. That is equal to 1 minus 0.3 divided by 5.24. 0.3 divided by 5.24. Look at the information, the question they have given. Annual dividend 0.3 lakhs. Annual dividend 0.3 lakhs. Therefore 1 minus 0.3 divided by 1 minus 0.3 divided by 5.24. I am getting 0.94 is the retention ratio. Retention ratio. Okay. So therefore my sustainable growth rate will be return on equity 40.3% into 94%. I am retaining 38%. I will grow 38%, but it's a very dangerous growth. You may be seeing that, sir, I am going very fast. Yes, fast speed thrills, but it kills. Speed thrills, but also it kills. So therefore, if you look at this point, you may think that, sir, I am going very fast, but you are taking a lot of risk. Look at this debt amount, leverage ratio, very, very risk. You are going on the 4th gear. You are going very speed, but very uncontrollable. Suddenly, if something comes, you are gone. That means suddenly recession comes, you'll not be able to pay interest on that debt. Huge amount of debt. This growth is not sustainable. So from formula based, we are writing sustainable growth rate. But if you apply your common sense, that much of fast is not sustainable. 1:4 may not be sustainable. Maybe it may be appropriate. That much of leverage will be appropriate maybe for financial institutions like banks or NBFCs. Banks or NBFCs, for them it may be appropriate. For normal companies, it may not be correct. For normal companies, it may not be correct. Okay, anyway, forgot about using common sense, etc. Based on the examples, based on the information given, look at this point. Look at this. Equity is given, debt is given. We got the total assets, total sales. We based on the information we have taken. Net profit margin they have given. Net profit we got. Preference dividend is no. Earnings available to equity shareholders will get. Equity shareholders funds same like about 1 lakhs. Return on equity. Earnings available to equity shareholders divided by equity amount. Okay, and retention ratio they have given 75, and sustainable growth rate will be 7.69%. Here the sustainable growth rate will be 38.0. Here that is the important point. This is the point. This is the important point we have to collect here. Here the important point, the entire problem, proposal number 1 is plain simple. Proposal number 1 is plain simple formula substitution. Only the proposal number 2 we should be careful. In the proposal number 2 we should be careful. Once we got this 52, everything is cakewalk. Or rest are all formulas. Rest are all formulas, and we should not forget this. So the debt is the key point. 12 plus 1 equity 13 lakhs will write, and this retention ratio. In proposal 2, these are the 2 areas where we should be careful. The rest of the things are same. Proposal 1 is very simple. Proposal 2, those are the whatever the red color I have highlighted. Those are the important points that we have to take care of. Okay, right. So this is 2A. In the next video, we will come out with 2B.